Hi, everyone, and welcome to Bitcoin Analysis Beyond the Block for May 2024, brought to you by Ainslie Crypto. My name's Chris, and today we have our expert panel with Isaac and Joe back to update us on where we are in the Bitcoin cycle with some analysis and discussion, looking at the macro fundamentals, market and on-chain technicals, and everything else in between. How are you going today, team?
Doing great, Chris.
Good, mate. Good to see you all again.
Good to see you. Now, it's been quite a big month. We've seen really quite a lot happening in the Bitcoin space, not necessarily movement up in price, but I would argue the setup has been in place. And certainly a lot of the things we talked about last month have played out. So let's just, well, we'll get into it quite quickly, but we've got that idea that we start off with that big picture macro overview. Then we'll look at the Bitcoin market analysis, specifically what's going on in the Bitcoin market, then the technical analysis. But there's lots to get into. So let's start off with that macro. And Joe, we talk about this every month, and I'd like you to sort of kick us off talking about it again, our global macro cycle indicator. So we've got the data there updated for April. So the May data will come out later in the month. But what are we looking at the moment? Where are we in terms of cycles generally?
Yeah, so if looking, I've done a few explanations over the last couple of months on how this works exactly. But what we're looking at the moment is based on those arrows. We've got green arrows there over on the right, which would indicate that we're in a mid-cycle. It's been a little bit choppy between early and mid-cycle, but generally speaking, we're heading in the right direction with a slight tick down, but we expect that to start ticking up over the next month, as we'll see in our ISM data that's coming up in the next couple of slides. Mid-cycle is indicating to us that growth and inflation are starting to pick up again, which generally is quite good for risk assets. So we expect performance and risk assets coming over for the rest of the year while we're transitioning in the mid-cycle over to late cycle. So the performance of risk assets, like we've spoken about previously, isn't quite as good when you're coming out of the bust phase, but it's still a reasonably good time to be invested in assets like equities and particularly Bitcoin.
And we were having a discussion earlier in the week amongst ourselves about the fact that really this is behaving probably a little bit more like early cycle than mid-cycle, but the data is telling us it's mid-cycle when you look globally.
Yes.
That really, though, didn't change our perspective, for example, because we would argue that it's the same. You want to be in holding that Bitcoin position in early and mid-cycle anyway. So we might not be absolutely certain that we're sitting we're certainly in an early mid-cycle if this is the mid-cycle, but we'd be happy with Bitcoin here anyway. That's how you would look at it.
Yeah, of course. The risk would being out of equity, being out of Bitcoin at this point, or risk assets in general.
Yeah, because certainly we see a lot higher to come. This is a different way of looking at it. Isaac, you love this chart, this idea of the same concept, but looking at it through seasons, and particularly when you're talking about crypto. What does this mean here to say that we have approached, or that 2024 is the year of macro summer?
Yeah, so we're in summer, and essentially what it's saying is, towards these areas in summer and fall, you'd expect a large amount of growth, right? So it also can mean that you can experience periods of stagnation. We've seen that in post-halving events, and if you look at in 2020 era, you saw consolidation for a bit, and then start to tick up towards that end there. So it wouldn't be a shock to at all have a bit of consolidation, tying that into the liquidity and the ISM and all those different data we're looking at. Would suggest we might be consolidating for a little bit, but towards the end, going into the later months, we could be seeing quite a large increase in price, and especially tying in with those seasons, which is looking pretty good in my opinion.
And that's why we're getting so excited about the end or the second half of this year, at least, because it does look like it's all lining up to have really what we have seen previously, these big moves.
Another thing I would like to note is I think the longer we consolidate, the less likelihood of the left translated theory. We were speaking about that before in the last episode.
Sure.
And that's better for price action, in my opinion, if we sort of form a range opposed to just shooting up right now and forming that blow off top. And obviously, in the long run, it would probably mean higher prices.
And that's such a good point, because it does help to you need these periods where it clears the sentiment out, where it clears the market out a little bit with consolidation, whether that's big falls, but it doesn't have to be big falls. Like you said, it can just be sideways move or consolidation in time that allows this to happen as well. But one way or another, we need that healthy correction to be able to sustain the higher moves that come after it. And that's what we're looking for. Joe, we've we've changed this indicator slightly from what it was previously, but it's showing the same information. This idea of looking at US growth, we preface this every time by saying the US isn't the globe, but US data is certainly something we want to look at because it's relevant to giving us a bit of fine-tuned insight into what we might expect. So if this is growth, what's it really saying here? What that we've seen? I've got the 3-month indicator as well, but the 1-month leading indicator here seems a bit choppy. What's going on with the ISM growth data?
Well, first of all, we'll point out that we've added the ISM services as part of the index, not just the manufacturing, which is the blue line. We got a bit excited last month. We were predicting that we would start to see economic growth in the US really start to pick up. That's fallen back a little bit, but it's reasonable to expect that you're going to go through a choppy period when you're passing through that neither contraction or expansion phase. We expect still, based on where we see monetary policy and fiscal policy in the next 6 to 8 months before the election, that will start to tick up, even though that indicator at the moment is pointing down quite harshly towards a neutral. So over the next few months, and definitely in the back end of the year, we expect that to start to pick up as we transition from mid-cycle to late cycle, and inflation and growth starts to pick up.
And I just think it's really an overreaction that we got from people as well, because looking at the blue line, which is what we were only focused on last time because we didn't have that services data in there, but when you look at it, it was just above the 50. So just that tiny bit of expansion going on, and now it's just below, just that tiny bit of contraction. So it's really dead flat. Like, that's sometimes you've got to zoom out a little bit. You can't be looking at each individual data point like it's make or break for the whole thing, when the data is effectively telling you the same thing the following month. So I think that was a bit of an overreaction that we saw from markets, where they went, oh, growth's collapsing. I mean, that just doesn't look like collapsing to me. Certainly on our 3-month leading indicator, it was looking great and is looking like we'll still head up. I would argue this is potentially an anomaly. If we saw that, like a collapse, looks like that continuing down significantly. But certainly this little move in the underlying indexes is hardly a collapse.
Yeah, I reckon we will get a basing effect next month, and we'll see that pink line start to turn up. But like you said, an occurrence of in the PMI of slight contraction is not necessarily a trend. So going through a choppy period, expect that to continue into expansion throughout the year.
We then go on and look at global liquidity, which is the area that we tend to specialize in, and we focus on this very heavily. The reason why I've spoken about multiple times, but I'll just remind everyone again, it's because global liquidity and world financial asset prices have a statistically strong correlation. So we can prove that there's a correlation there, that the more liquidity that's pumped into the system, the more that global asset prices go up, and the more liquidity that's drained from the system, the more that we start to experience issues with liquidity. When we look at the weekly global liquidity with the latest data, Joe, we've had this real dip and pull back up at this weekly level. We were talking for a long time about the potential for let's call it air pocket. That was some of how it was being termed, a little period of time where liquidity wasn't going to be strong. Are we on the other side of that now?
First of all, I'd like to say that we completely predicted that last month and the month before, based on where we saw monetary policy and liquidity policy throughout the United States and the world, which meant we did have that rocky period in markets. That's played out quite pretty much exactly as we predicted. As we can see, it's starting to turn up past that 171 trillion, making its way to 172. We once again expect that as we're moving out of mid-cycle or into mid-cycle, and then later on into late cycle, that to continue picking up, which will drive markets and then also drive economic growth.
Makes a lot of sense. If we look at it, like we go a step further and look at the liquidity, saying that it's really quite important, because when you take global liquidity, which is that black line, it's always going up in the long term. It's just the short-term gyrations that we care about in terms of trying to time a little bit for the markets. But we know that crypto and gold, so particularly here, crypto meaning Bitcoin and gold, keep up with that monetary inflation. CPI inflation, which you mentioned, growth, the other part of that equation is the inflation side of it. And that just simply doesn't really matter how high that inflation rate gets, unless it gets to extreme double or even triple digits. While it's still down in the low single digits, doesn't really matter what that does. It's not going to keep up with the amount of liquidity that's going into the system.
Yeah.
So your wages, if you think of this as your wages, they're just not keeping up with the overall amount of growth of liquidity in the system. That trend seems absolutely in place. As I said, we tend to focus more on the gyrations. This is looking what that looks like. We get the peaks in liquidity, the troughs. That's what we saw with that pullback that we had into the low in late 2022. And really, since then, we have been on the trajectory higher. Looking at that through our visual sort of color chart here, Joe, do you want to just briefly talk about this and what this is actually showing us in terms of what we can expect going forward?
So red is tightening liquidity. So this chart is an entire heat map of central bank liquidity. So after COVID, you'll see over there to the left, it was extremely green as the central banks and governments tried to kickstart the economy after COVID. The red patches is where we realized that inflation was not going to be transitory, and that financial conditions tightened, which drove markets down. And now we're slowly transitioning back into the green, which is liquidity positive, which is also fantastic for markets and therefore spilling its way into the economy.
And it has been a bit sluggish. Like it's fair to say that we've seen this red linger for longer than we probably would like. But is that similar to what Isaac was saying before? You need that consolidation flush out period to allow the higher highs to come. Is this a little bit of what we expect to see with liquidity as well?
Yeah, that's a symptom of the recession not coming as quick as everyone thought it would be after raising rates in the US to 5.5%. If the recession had come sooner, we would have seen that turn greener sooner. But at the end of the day, at some point, based on the fiscal situation, the fiscal spending, that's going to start turning green, and the central banks are going to have to accommodate the government with helping backstop the bond market through after the financing that they have to do to actually get the fiscal policy out there into the markets and to the people.
That makes a lot of sense. Now, Isaac, we've talked about this. We talk about it every month. This chart of liquidity against Bitcoin cycles, and we've consistently seen, particularly in the lows in the cycle over the last couple, which ties into what Joe was just saying about government debt and all of these things becoming more extreme. We've seen the lows line up spot on with the lows in the liquidity cycle. We've had that little bit of a lagged effect because we had the double top, which is actually clearer to see on the next chart, that double top that happened after the COVID spike. What's going on here? Because we've got what seems to be this, if this is our what we're talking about, that air pocket of liquidity, we've had that over the last few months, now potentially turning up. Does this mean that Bitcoin's heading down now? What's going on with this line?
Not necessarily, and I don't think that is an indication that it is going to be heading down in that long run. What we see here is actually a little bit of a divergence, right? So you're seeing global liquidity decrease and price increase. Now, this could be multiple reasons. It could be people trying to front run the global liquidity, thinking we're going to enter a time where money is more accessible, liquidity is going to be trending up overall, as we know, and as we are planning to. So we definitely could see that happen. And to me, this is not a worry. I think it's actually rather showing the strength of Bitcoin, in my opinion.
I agree with that as well, because something that's really important with this line is to understand that the blue line is in nominal dollars. It's not a logarithmic chart. So Bitcoin just moves so far that if we see much higher prices into the hundreds of thousands even for Bitcoin, this is going to look flat. So it can be a bit of a visual distortion of how that's playing out. But certainly another point to make is that this average Bitcoin price for the month is showing that the average price over April really didn't fall very far. So yes, we had huge movement ups and downs in the individual candles that happened during the month. But when you filter out all of that noise and just get the underlying signal, what did the price do on average for the month? Barely moved at all. So I would actually say, based on what you just said, it's a very strong sign for Bitcoin that it has held up so well.
Yeah, 100%.
All right, so we've covered that big picture macro where we always start, because it's good to sort of start at the top, see what's going on. We then go into specifically looking at some things related to Bitcoin itself to sort of look at the Bitcoin market and the health of that market to see if it lines up really, because we want to put all these pieces together to come to a conclusion in the end. So the first one we've got here, your Bitcoin market to realize value. Isaac, you've talked about this multiple times in the past. Do you just want to give us a quick update?
Yeah. So I'll quickly tell you what it is. So essentially, it's telling you the average cost basis of all Bitcoin in the system. Now, that's the blue line, otherwise known as the realized price. So what we're seeing right now is we're actually seeing the MVRV ratio, which is the orange line, start to decrease. Now, what that means is the deviation score is starting to decrease. So it hit a level of 3. We're now sitting at around 2. So the more we actually trade around this region, it actually raises the realized price, which is that blue line. And as you can see, it's actually starting to trend higher, even though Bitcoin is consolidating / falling down slightly. So this is actually good in the long run because it means we have a higher vantage point to start from, especially as we go into that region where more liquidity is going to be in the system. So that's a positive sign. Now, in terms of looking for tops with this indicator, we can see that, in the history of it, it's reached quite large extremes. So levels of 10, 8, and 7. Now, I'm not suggesting we're going to be reaching those levels this cycle. In fact, I think it will obviously be less because we know that as assets evolve, the volatility becomes less in the timeline. So what we could be looking for, if you draw a trend line straight through that, it points to around the 5.56 mark. So we could definitely be seeing some sort of deviation around that mark. But you know what? Even if more trading occurs and we see price sort of, instead of shooting up very fast, just sort of trending up higher overall, that could, obviously the deviation score doesn't have to be so extreme, but we could raise price whilst the realized price rises with it. And that's going to be actually probably more healthy opposed to having a giant blow off top like that. So yeah, that's my opinion right now. I think we're going to be hitting towards upside soon, especially tying in the 60-day cycles, which what we'll look at next.
Sure.
But especially with bottoms too, I'd like to add that when you reach those levels of 0, meaning the market price is at the realized price or even lower, that's perfect time to be buying Bitcoin.
And I think that the theme so far seems to be emerging that these pullbacks are very healthy because it gives you opportunity for the next run to be starting from a much lower base so that it's not all just taking off and being becoming unsustainable. So very healthy this last couple of months that we've been through. This is your chart. You always talk about net unrealized profit and loss. Quick update on this.
Yeah, so this one's just showing us most people in losses are unrealized profit or loss. So right now we're actually in the euphoria / greed phase, but we can stay in this phase for extended period amount of time. So if you look down the 2017 era, you had a large extended time frame in that region, and even towards the 2020 run there too, you can see we hopped in and out. It was a bit choppy, but just because we're in it, just because it's flashing green doesn't mean the top's in at all. Because I know a lot of people are seeing these metrics and thinking, oh, we're signaling the top's in right now. So, and we obviously have the macro backdrop, which doesn't seem to signal that at all. So you got to have that multi view that takes in many things to account. But essentially, it's the same thing as MVRV.
Yeah, absolutely. And speaking of multi-view, that's why I use this chart as well, isn't it? The combination that pulls several of these things together.
Yeah, so this is the combination chart. It's got a wide array of different metrics. There's around 10 indicators. Now, right now, we're flashing around the 67% mark, which means what it does is it says there's a 67% chance the top's in. And what you see is when you reach those red levels, it signals around the 99 to 100 region, which has happened in all the previous cycles. I'm not suggesting that it has to hit 100 again. It doesn't have to, but it has a track history of doing it. So, you kind of expect it to do the same thing according to the past. So at the peak of where we were, I think it was around a month ago, I think we were hitting around the 80 mark. We did in the last video. So 80 mark that's not anywhere near the 100 to 99 region. Still a few more points to get up there. But we've dropped back down to 67, which is a good sentiment reset.
And going sort of the next step, because we look at that for those broad-based technicals, then we tend to look at sentiment through different metrics again. Sentiment is so important, as we know, because it tends to be a bit of a contrarian indicator that you sell when others are greedy, buy when others are fearful. That type of metric. How is that going this month?
Well, as we can see, we're actually seeing that flush down. So we're currently sitting at 56 on this fear and greed metric. This is the more macro one. So that's quite good, actually. Respective for how much price has fallen, I think that's quite a good reset in sentiment, hitting those neutral levels. Preferably, I think it would be nice to see it hit even lower, just to really flush out the weak hands. You saw that in those other green boxes I've highlighted too. It went a little bit lower there too, especially there. I think it dropped down to 45 on that one before we had the parabolic phase in the 2020 cycle. So yeah, it would be nice to see that, but I'm just going to take it with a grain of salt. It's good. It's good to see a reset.
Well, it's certainly not. We got something, so something's better than nothing there in terms of a pullback. And the risk, I know Joe would say that the risk is that you're not in and that it takes off because you're just waiting, that saying, well, it just has to go that one lower, and it just doesn't do it. You also look at sentiment more on a short term metric, and you bring this one up each month as well. Can you just give us a quick overview of, because this is pulling it from several different sources, isn't it?
Yeah, this one's way more short term. So you can see in the scales down below. It's way more short term. The other one was quite extended, capturing multiple cycles. So what we're seeing right now is, well, I'll quickly explain it. So it's essentially capturing all the different forums, Reddit, Twitter, and essentially collating all the information, tracking keywords. It's an AI model that does it. And you print out a score. So when you reach those levels where the sentiment score, which is that orange line in the top one, when it reaches those lows in the chart, it's typically signaling that sentiment's quite bearish on the short term, which often offers a nice bounce in price. It's funny how that works, because when people are bearish, it's actually a good time to be taking positions. So, and you can see that in the chart, sort of exemplifies that. So where we're sitting now, we're at 44.48. I'd say that's much more neutral, and I think price also reflects that too.
Okay, so that's looking good. A couple of other metrics you use, the Google Trends seems to be heading down here. Is that just people, that the froth has gone, people aren't searching as much for these terms?
Yeah, I think, well, we had the ETF hype, and then not hype, I wouldn't call hype, but we had that coming into that. And then we also had the all-time high come in, and people were searching that. And, I saw articles on that, people were talking to me about it, my mates and stuff. That's died down definitely from an anecdotal perspective. And then also on Google Trends, you can see that too. Obviously towards the end of the cycle, we'd like to see this rise up. And I think what's going to captivate people is potentially more institutional demand coming in. Maybe even what Bitcoin's meant to be, the narrative that, it could be a store of value and of course to be used heavily as a utility. But that's hard to say. That's narrative based, and that's sort of what captures the masses in. Or just purely green candles. That could be one that captures people into.
It certainly does. We know that does. Now, this is a new metric you've added this month to look at, which is new addresses. Now, you think also this might be something that drives, or at least reflects the drive to more growth that we see coming in this next phase of the cycle?
Yeah, essentially, what we'd like to see is some sort of narrative catch heat, whether that's what we just discussed before, green candles, etc. And then we'd like to see those new addresses come in to sort of allow new capital to flood in, which I think would be good. And we'd like to see that tick up opposed to, going down.
This monthly Bitcoin analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy, sell, and swap gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. Joe, handing over to you, we've been looking at this each month. It's been really a big development this year that we've had to pay close attention to, and you've been all over it. What's been going on with the ETF flows this past month to catch us up?
Well, I think if we relate it back to what Isaac was saying in regards to sentiment, the ETFs at the moment are certainly trading like sentiment. So, in the lead up to the local top of 74,000, we had huge flows coming in, and like Isaac said, the narrative was very strong. So a lot of FOMO, a lot of volume. Even looking at the actual trading volumes of the ETFs were quite high. We're actually starting to see that tail off a little bit now, and you can see that with the inflow or the flows in and out over the last couple of weeks. Generally speaking, we've had mostly outflows, as what we call paper hands have sold their ETF. They might have even bought the local top and they've just taken the loss, or it could have been some of the people that were buying quite low and they can't handle the volatility, so they just want out. But once again, once that narrative flips, once the price action starts to flip, I fully expect those volumes and ETF flows, net inflows, to start picking up again.
And I think it has been kind of boring. Like let's put it that way in the ETF space, where it was really exciting before because it's normalized. But do you think, and I know that's what you've bought some other charts to look at today, do you think that that's just what we would expect from where it is in the cycle? Because I know there's been some commentators in the market who are trying to say this is maybe retail driven speculation that's causing massive falls, or there's going to be big outflows out of the ETFs. I wouldn't argue we've seen unreasonable outflows at all out of the ETFs. I'd say they've been very measured and reflecting really what's just been going on generally.
Yeah, so based on the assets under management for each of those funds, the amount of outflows are not really that much at all. If it's that they trade a lot, I suppose, like the spot market, like that you and I would trade, for example. You've got your smart money, and you've got your retail that at the first sign of trouble they dump their holdings. So at the moment, we've got a lot of US companies and investment companies filing their 13Fs, which are all due by 15th of May. And basically what that is a disclosure of the assets that they've invested in. So we've seen a lot of relatively large investment firms and banks, for that matter, declare that they've got ETF holdings, and that ranges from in the hundreds of thousands into the tens of millions. So just a quick example, we've got Wolverine Asset Management reported having $62 million worth of shares between ARK, BlackRock. You've got Swiss Bank UBS, not a huge holding, but they're dipping the toe. Then you've also got Investnet, which have $55 million worth of ETF shares with a $6 trillion in assets under management. So not necessarily huge numbers, but pointing in the right direction.
And yeah, you've been keeping me up to date on some of those as they've come in. It really is quite interesting to see the breadth that's going on there. So I really don't think you could argue it's just wild retail speculation on buying some of the ETFs, because otherwise we wouldn't be seeing it across so many. In terms of the 4-year cycle, which you've brought this chart along today, the argument, of course, would be that the current one we're just here and every other cycle at this phase or this many months into the cycle, we would be preparing to take off. Is that still how you see it for this cycle?
Yeah, I brought this chart just along for mostly perspective. A lot of people are starting to get that negative sort of bias, and there's nothing like a bit of price action and a couple of months of no good price action in the past to get that negative driver. So this is really just to show the other side of that coin, where we're at 350 days into this bull cycle, for example, and we're basically halfway there. So there's no reason on any of the metrics that we're looking at to assume that the bull market is over.
And you take it one step further by looking at the halvings in particular. Now, we've just been through that within the last month. What's this chart showing?
So it shows that there is usually reasonable price action leading up to the halving. And once the halving occurs, it's a little bit of a sell the news event. And you do get those periods of chopping sideways, potentially down. This is a great chart because it obviously zooms in a little bit more versus our 4-year cycle in the previous chart. So you can see specifically in this chart that you do get those choppy sideways periods for a while, and a lot of people get shaken out in that because it does that sideways price action certainly makes people turn a little bit negative in their sentiment.
And yeah, I think perspective is the right word, because we've only just passed that period and people just expecting that it's all going to take off because that's what it's always done. They see it, but they think it goes straight up like that. Like they forget that even in the most aggressive cycles, it still took some time to see those big gains. So a little bit of patience required. It's kind of the same thing we were saying before when we looked at the Bitcoin chart and you use the average price for the month and it's barely moved. During the month, you feel like you've been through the washing machine or been on a roller coaster, because up and down all over the place. But if you step back and look at how much it's actually moved, the average has moved barely anything. So it's the same sort of thing through this, that we really do need that perspective. Another chart you bought, which is really fantastic for perspective, is this one. I really love this chart. Can you step us through it?
So it's just basically the amount of money that's in individual asset classes. So gold, there's 16 trillion, which a lot of people like to compare Bitcoin to. You've got art, which is a bit of an anomaly. Most people don't even realize that art is an actual investable asset class. Investable cars and collectibles, and of course we've got equities, real estate, bonds, and literal money in the world. So as you know, Bitcoin's at approximately 1.3, round down there to 1 trillion, but for the sake of argument, it's still a very tiny portion of in terms of of money flow as an investable asset, and how much is actually allocated to Bitcoin. Particularly when we talk about what we were talking about previously with asset managers starting to allocate funds, like large asset managers starting to allocate funds into Bitcoin as an asset class, and you know that's just the trickle before the flood. Like, it's got to start somewhere, and we've started that process.
The absolute power of this chart to me is these two: the cars and collectibles and art, because I just don't think people grasp that can be nearly 20 times larger, and it's something that we don't even think about as being an asset class that would be allocated to. Like, you don't generally go to your asset allocator, whether it's your financial advisor or your fund manager, or however you're operating, and say, how's my art allocation going? Like, obviously people are, because it's a massive number, but it's just not thought of that way. So when you consider how small this is, it really does show how much potential there is for this growth to continue to occur, much beyond what the average person probably estimates.
Absolutely. And I think over time, over the next 5 to 10 years, we're going to see a lot of that money start to flow into Bitcoin as the new asset class emerges.
Yeah, you can see it clear as day from that, as far as I'm concerned, looking at it in that way. So we've covered the big picture, the macro. We've looked at the market sort of not the breakdown of the market and how it's all looking there. Now is the time to get specifically into the technical analysis, and this is sort of Isaac's time where he really goes into a lot of these charts. He actually brought a lot of charts today to cover, so we'll move through them fairly quickly. But the idea of this is to really add some additional flavor and color to the framework that we've presented. So we've got that idea that we're probably mid-cycle. We've got that, or early mid-cycle, if not full mid-cycle. We've got that idea that the Bitcoin is tracking pretty much where we would expect it to in terms of cycles and things so far. So let's have a look and see what the technicals tell us, if that all lines up. So the first one you brought here, Bitcoin cycles. Do you want to step us through that, Isaac?
Yeah. So obviously, since then we've had the halving, and what we're seeing now is we're going through the consolidation phase, which we've seen in previous cycles there too. And what it's also showing you is we have quite a long time before we reach that green section, which is on this indicator, is a section where you start to take profits. It's just based on timing, right? So we have a few good, like a year or so, which would be nice. There's also times in what other stuff we're talking about too. But yeah, it's got the DCA bullets there, so potential spots to buy. And it's also got the profit start, profit end. I'm going to be showing this indicator throughout all of the videos we do, because I think it's quite a good one that grounds us and gives us that perspective. So
Absolutely.
Yeah, in terms of timing.
I was just going to say, it's absolutely great to see something like this as well, supporting, because this is coming at it from a different angle, but supporting a similar outcome to the one that we were discussing in terms of the liquidity and the other cycles that we see playing
100%.
out. This is a different view of the cycle, but you've got here, again, a different way to approach it, looking at some specific indicators.
Yeah, so what I've got here is I've got the stochastic RSI and then just the normal RSI there too. And I've just got in the green, those green bars at the top, they're sort of just showing the length of the bull run. So you can see that there. I've also highlighted in days too in the previous cycles. So you've got 1,400 around that time. And you've also got the red, which is the bear market there too. All right, so where we are now, we're essentially halfway, like you guys were saying before. So we have a long, decent time to go in terms of timing. One thing I would like to note though is on the stochastic RSI, the momentum is slightly shifting down. Now that's not to fear, because what I would like to see, and I think is going to potentially happen, especially looking at the 60-day cycles and all the other metrics we're looking at, and the other stochastic RSI, which we'll look at in the weekly time frame. It's actually pointing to higher locally. And what that could mirror essentially is the 2016, 2017 era, where you start to see this choppiness around the top regions. It doesn't have to be exactly the same as that, but essentially you don't have that full momentum shift down like we saw when the bear market comes in. So you can see that during, essentially there, 2021, you can see that happens towards the end of the cycle when the momentum shifts fully down. We don't want to see that because that would be quite bearish in my opinion. So instead, we'd like to see that RSI start to scoop up relatively soon in the next few months.
And yeah, perfect example there, that it can maintain that for a long period of time. This is zooming out at that weekly level. That's what you were just talking about, isn't it? That we've got the stochastics there actually indicating a bottom potentially.
Yeah, so this one right here is quite good. It sort of ties in with what we were saying before, how we want to see that stochastic sort of tick up on the monthly time frame. So here in the weekly, we're starting to see that really tick up. And just for illustration of what's happened in the past when it has hit those bottoms and tops, I've got the green, which signals a stochastic flip on the bottom, and the red, which is a stochastic flip on the top side. So expecting downside. And as you can see, it's been pretty accurate in terms of predicting either, for example, say you're picking to the downside, it's been good at picking it's either going to consolidate or fall if it's signaling red. Likewise with the green aspect too. So what we could be seeing is potentially seeing some good price appreciation relatively soon, which also funnily enough times in with the 60-day cycles.
And this is a point I keep reiterating a similar point, but people sometimes expect that when you get a red like this, it's just got to crash. And yes, we've had some price movement. It hasn't been a traditional, face ripping off crash into massive lows, but a consolidation in time is acceptable as well.
Yeah, and it doesn't have to obviously fall that hard. It can fall relatively light, and even if you consolidate, and you can still see the stochastic start to trend down. So it's essentially just showing the momentum shift, and we're starting to see that start to tick up. I don't know if it's flicked yet, but I think it will in the next few days.
It's looking very close from that.
Yeah.
Your next chart here, bringing it into the daily level.
Yeah. So what we've got here is I've got in that green one, key level to claim. It's around that 63 K region. I've got that as a level to claim as it's a volume node for the whole entire region, as you can see there, and also the value area low. Now, if you guys don't know about value area regions, essentially there's an 80% chance if you claim the value area low that you rise to the value area high, which is that blue line at the top there. The green one I also added there because it's a high volume node, so that might offer some resistance too, along with that liquidity top there, which is going to be not too much liquidity at the top there, but some stop losses might be there, and some traders might be looking to short sell that. Which also ties in with the head and shoulders pattern.
So we've got a bit of move between here and where you would expect that next target.
And I would also argue that also ties in with the head and shoulders pattern in terms of a target traders we're looking to sort of long. So you can see that you got the shoulder, the head, and another shoulder on the right side. So we could definitely see that pattern sort of play out. Even on the market cipher, which I've got down there, you're starting to see those green dots appear. And funny enough, you're even seeing a head and shoulders pattern on the market cipher. So it does time well. I think it is looking for local bullishness, even with the 60-day cycles, which we'll go to soon. But that's not saying we can't fall a little bit more, because we definitely have that extended period between this to fill out those 60 days, which we'll see in the next slide.
So I really like this chart, the cycles being indicated on that 60-day, which do vary. I mean, it's not exactly 60 days, but you seem to get this fairly close, consistent play in Bitcoin that about every 60 days you have a cycle where you get somewhat of some form of cycle high, some form of cycle low. Are you indicating here that this is about the timing we would expect to see that next low, so we could be approaching that very soon?
Yeah, so if it does hit that region, that will be a 60-day cycle from the last previous one we've got there. I'm not suggesting it has to do that. The bottom could be in now, but it could obviously bottom. It's just that approximate region, that time, within that sort of, because it's the daily cycles, within those few days, you got that time period, which you can see a bottom there too. If you do start to go down further into that cycle, it would be cool to take out that liquidity and then sort of bottom there. That would be a cool thing to do. I'm not saying it's going to happen at all, but it's ultimately, we're sort of speculating in terms of the time frame and the days. But in that proximate region of 60 days is where we'd expect to see some sort of daily low.
And you run the risk of, this is probably one of those good situations where we've retraced a decent enough amount from the top that, yes, we might make our way down here, but you wouldn't be betting the farm on it. You wouldn't be waiting for it to get down there. If anything, you'd be starting to buy in if you were trading in that sort of format, in anticipation that it could get there, but also this could be the low already, and we could be off to the races and you miss out. So yeah, I like that chart. I think that shows that pretty clearly. You've also got the pi cycle indicator. Now, this is one that seems to be very popular with a lot of people. Do you want to just sort of explain to us what it actually is?
Yeah. So on the bottom here, you can see you've got the price, 350-day moving average, and you've also got the 111-day moving average. And what they do is they couple them together. And when you start to see them sort of dance together, I would say, that's when the top is generally signaling in. So in previous cycles, they were actually bundled together quite for an extended period amount of time, especially in that run there you're pointing to, right? In 2020, during that run, they had a brief moment where they touched, and that was signaling at the top there too, which is also exemplified in the oscillator with that red band, when purple line reaches that top there. So we could argue we're relatively close. We could also argue that we're seeing the sort of formation like 2019, where we came near it and we sort of ticked down and then went back up. So again, it's one tool in the toolbox, but it is something to be looking at. And when we do see that, if we do see that crossover with the two lines, that would be a sign to be starting to look at that more bearish side, in my opinion.
Okay, and we're coming to the end of sort of all the different tools you bring to look at in this technical analysis world. This is one that's been interesting, and you've talked about quite a bit, these liquidity zones. And like, obviously, this is different to when we talk about global liquidity. You're talking here specifically about liquidity in the Bitcoin trading market and these zones where it tends to clump together. Do you want to explain, because it looks a bit messy to the untrained eye, what we're actually looking at here?
Yeah, so the regions where you see that high dense yellow, it means there's a lot of liquidity. So that could be stop losses and all those different kinds of things. So what typically tends to happen is high liquidity regions is where big traders and big sort of whales will come in and try and scoop up without affecting price too much, because there could be limit orders. They would set limit orders down in those regions. And you also see like when stop losses get hit. So if you're doing a short, you have to buy back, and essentially, these are regions where price can tend to flip. And what we're seeing now is, I think I spoke about in the last video, I was saying that liquidity wick. If you go back, you can see there's that little liquidity wick there. There's that yellow line. So there's two of them, and it took a while, but we eventually hit it, and we've seen that nice big bounce from there. I think it was around the 10% or maybe like 7% bounce, which is something you'd expect from those sorts of regions. We do have quite a strong one down at the 52K region. But whether we reach that is, I'm not personally expecting it currently, based off where we are in the 60-day cycles now, and is going forward. But we could hit it. I'm not going to rule it out. So we still have it on the chart. And then to the upside, we have those regions of those tops, like I was saying before, in terms of the head and shoulders. We could reach that top there, which would be around the 67, 68K region, which would hit a liquidity high there too, locally, obviously.
And then that big one up the top there.
Yeah, that's it.
For sure. Okay, and the last one you've got here, looking at your cumulative volume delta. This is one that previously you've sort of had lines on here showing us divergence. Is one that you look at to really highlight anomalies in the market. What's going on with that this month?
Right now, to me, nothing is signaling anything, just more so just a healthy consolidation. We're not really seeing any divergence on any aspect, in my opinion. Open interest is very just neutral, and CBD is more neutral, not enough to signal anything to me. I like to see sort of exaggerated things. That's how it generally works with CBD. And even price is sort of reflecting that CBD and open interest. So nothing to be concerned about, in my opinion.
That's great, because sometimes nothing to be concerned about is what we're after. And I'd argue potentially that's, at this period of time, that's exactly what we're looking for. We're not looking for strong signals anywhere. We're looking for it to be a little bit exhausted, no one to really be paying too much attention so that it can set up for big gains ahead. Well, that's fantastic. I think we've met our objective yet again, of covering all these things and really bringing it all up to date. So let's sort of wrap up with some final thoughts and expectations for the month ahead. Joe, we'll start with you. From everything you've seen, the things you brought along, what are your final thoughts? Where do you think we're heading from here?
Well, from here, I expect in the mid to long term, like I don't necessarily try and predict the short term. That's not what we do here. But you know, as I've said the last couple of weeks, that those dips are for buying, and don't worry about it too much. If we track sideways, go outside and get some sun.
Touch grass, is that the saying?
Yeah, something like that.
Right. Isaac?
Yeah, locally, I'm expecting a little bounce actually, 60-day cycle wise. It doesn't mean it happen right now when this video is posted, but within that time frame. So yeah, the next few days we could potentially see that, especially with stochastic starting to flick up. And then consolidation. We can see the consolidation for the next few months, which we've also been talking about too. Plus, we've also been shown the charts of what happens post halving, and yeah, it starts consolidating for a bit, and that's perfectly fine. Sort of resets the sentiment. But long term, I think the backdrop macro wise is signaling towards more money in the system, which is going to obviously, and we have that high correlation rate between local global liquidity and then risk on assets. So that's going to be really helpful going forward. So yeah, that's my opinion.
That's fantastic. And I think to wrap it up with mine, looking at everything that both of you have presented today really lines up well with what I tend to look at closely, the global liquidity thing. I think from Joe's analysis before, I think we have probably passed that air pocket in global liquidity. It's going to start flooding back in. I mean, we're very close to the second half of the year already. We're well into May, and then it's June, and then we're in the second half. So it's not that long away. And I think it's playing out to the letter as a typical cycle and what you would expect to happen. So I'm very bullish. And when I see some of those indicators, particularly those timing ones that you brought along, Isaac, looking at the 60-day cycles, that they really end, or the next cycle is expected to begin any day now. So we're right in that timing band where we could expect to see some takeoff from there. I think it's all looking great for the month ahead. Maybe we end up with a little bit of chop still, a little bit sideways, but I wouldn't be surprised at all that we come back in a month's time and we're sitting at higher prices than we are now. So it's all looking great as far as I can see. Well, thank you, everyone. Thank you to our panel. Thank you for bringing along all that work today. Really appreciate it.
No worries, Chris. It's been great.
Been happy to do so. I love the discussion.
Yeah, I do as well. It's a highlight of my month coming along and discussing this stuff. So thanks for your work on it. Thanks everyone for watching. We'll chat again soon.